So now we've considered 7 different areas to think about, and we're going to move to a more specific area in the process called a management buyout scenario. And our second speaker, Lloyd Compton. Lloyd leads the business valuation group at MRSB Chartered Accountants in Charlottetown, Prince Edward Island. Lloyd is a sought-after speaker. Notably, he's spoken to the Canadian Bar Association, the Law Society of PEI, provincial and federal governments and agencies, and the Canadian Institute of Chartered Professional Accountants about business valuation topics. Lloyd is also active in the mergers and acquisition space, working on transactions ranging from $1 million to $50 million in enterprise value across a variety of industries, and has facilitated over 120 transactions. Lloyd, looking forward to you explaining to us management buyouts.
Thank you, Ron, and thank you everyone for joining today. So management buyouts is really kind of a fancy term just for transitioning the business to an employee or an employee group. It's nothing more than that. And how do they normally come about is the business owner sits down with their advisors and decide on the best approach for selling the business, and they weigh the pros and cons of going to market versus looking internally, much like you might do if you were looking to hire a high-level executive. So typically the buyer, as I say, is the second in command, the CEO of the business, or some sort of management group that comes together and pools their resources to try and acquire the business. And it can be initiated by the owner or by management themselves. So occasionally management will find out that the business is for sale or speculate that it may be coming for sale and put together a proposal to acquire the business. It may be a company that's in distress and management still sees potential, or it may simply be that the management sees what they would do better if they owned the business. So oftentimes management are the biggest critics of how the business is being run and say, boy, if we owned this thing, what we could do with it. So it's their opportunity then to take that stage. And then as business owners approach retirement age, they often don't have the same investment horizon that say management do. If somebody's in their 60, 65 years old, they're more reluctant to invest the kind of money into expansion and new equipment and new processes and technology that say management might be if they're at an earlier stage in their life.
Lloyd, would it be fair to say that all members of management are good candidates for a management buyout?
Yeah, definitely not. Good question, Ron. There's some people are employees for a reason because they don't have the risk tolerance to be an owner, to be an entrepreneur. They might not have the financial resources, and they just may not have the same sort of mindset that it requires to own a company and to see the growth opportunities. So definitely not everyone is a good candidate.
Could you take, if you had a management team of say 5 people, would you entertain 3 or 4 of them and not all 5 of them?
Possibly. That the dynamics are really important. If you put together a group and that group don't particularly want to be a group, that could cause problems. You're forcing essentially a marriage where there may not have been one to begin with. So you have to be very careful when it's a management group that everyone's bringing something to the table and there's reasons for them being grouped together. So why might you consider an MBO? They're a very useful tool, as I mentioned. They're useful for small to medium-sized businesses where the market may be more limited for buyers. Competition, the more competition you have when you're selling your company will translate to a higher price. Competitive tension generally drives the price up. But if you don't have a lot of buyers, sometimes it's best to look within and look at the quality of your own people. And so transfer of family businesses to the next generation, that's simply a management buyout. It just so happens that the management are family members. And it can be a smoother transition than a third-party sale because the managers already know how the company operates. They know the employees, they know the markets, competitors, and they also know where the skeletons are because they put them there. So they're less afraid of the transaction than perhaps a third party. There's a little more trust between buyer and seller. The other big plus for a management buyout is that it's more confidential. So anytime you go to market, you've got a lot of people are going to find out about it. You can get all the confidentiality agreements, non-disclosure signed, but reality is there's going to be a large number of people and professional advisors that find out that the business is for sale, and that could be damaging to the business. Also, management's continued presence. So if a management takes over the company, that can reduce some anxiety with staff, suppliers, customers, and that sort of thing, as they see it more of a continuation of the business as opposed to somebody new who's owning it and what are they going to do with it. And then that familiarity of management can speed up the closing process. So due diligence is typically more smooth in a management buyout than it is with a third party, as I say, because they know what's been swept under the rug and what hasn't. And the other positive that people don't often think about is seller's remorse. So seller's remorse is a real thing. We see it all the time where somebody sells their business and then regret it days and years later and think, what have I done? When it's a management buyout, the owner still kind of sees it as a continuation of what they began, and they've got a familiarity with that management, and they're a lot more comfortable to walk back into the business and check in on them and see how they're doing and provide advice. So there's much less seller's remorse in a management buyout. Some of the reasons why you might not consider a management buyout, or maybe that you wouldn't discount it altogether, but things that are on the negative side of the ledger, is that lenders might question the abilities of management as an owner. So as we mentioned earlier, ownership and entrepreneurship is a special skill, and not sure if it can be learned or taught, or if it's something you're born with. But sometimes lenders can question whether the management will have the ability to run the business the way it has been. And they may question whether there's a high level of personal goodwill, so that after the original owner walks away, will the business suffer? The other big item is transition from being a manager to an owner is a big step. You on a Friday go from being a coworker sitting in the lunchroom with your peers, and then on Monday you're the boss. That's difficult for a lot of people, and difficult for themselves, but also difficult for the employees to now start treating them like the owner as opposed to a peer. Perhaps the largest item, though, that causes difficulty with a management buyout is that managers and employees typically have a lot less capital. So if you go to market with a business, oftentimes the buyer is a strategic buyer or a financial buyer that either have a lot of cash or have access to cash. And so the amount of debt that the owner will have to keep or vendor take back is much less in a third party sale than typically it is with a management buyout. And finally, one major reason you should be careful before entering into a management buyout is that if it doesn't work, the negotiation process can be damaging to the relationship between the owner and the manager. And if it is very damaging, it could be critical. And if that manager leaves, it could be damaging to the value of the business. So if you're now going out to market to sell the business and that manager has since left, the business might actually be worth less.
Lloyd, in previous sessions, we've talked a little bit about transition from the current owner to the third party buyer. How, in your experience, how have you found a successful way, or maybe there isn't one, perhaps there is, of dealing with operational control? Like what point in time does the day-to-day decisions move from the current owner to management, and then finally on the legal control? Because I think you mentioned something about a financing issue.
Yeah, well, usually the operational control would follow legal control. So you would turn over the operational control once there's 50.1% of ownership transitions to the new owners. And ideally, that's done as quickly as possible, for the main reason being that former owners don't make good employees. They have the "I told you so" or "I've tried that, don't bother" kind of mentality, and the new owner wants to get them out as quickly as possible. But it will largely be driven by the ability to get financing. So if the management group can't come up with enough money to make that transition to control quickly, then it may have to be done over time using the profits of the company to acquire ownership. And if that's more gradual, typically we wouldn't see operational control transferring until legal control. And once that happens, so if you structure that over a number of years, for instance, let's say 10%, 10%, 10%, at the moment it crosses over 50%, it's going to be a deemed change in control for CRA purposes, and there'll be a deemed year-end change at that time. So something to keep in mind in terms of timing the transaction.
Okay, and I think you're going to talk a little bit about how financing is put in place. And the question we have from the group is, what type of security is typically pledged to the vendor in the management buyout? So perhaps when you walk through what financing looks like, you can touch on that specifically.
Sure. Yeah. So in financing, the typical process of a management buyout is first the management team have to gain the confidence of the owners and vice versa. And then when the MBO is introduced and both parties agree to enter discussions, each party gets its own legal and financial advice. And depending on how much capital the buyers are able to raise will depend on the negotiations. So the vendor may have to hold back a significant vendor take back. Oftentimes we see it being greater than 25% in a management buyout situation, where in most third-party transactions, the vendor take back is less than 15 to 20%. So obviously they're going to want security on that vendor take back. And the security that we would typically see would be a personal guarantee and the actual shares of the business itself. And then a second charge behind whatever lender there is. So the vendor is going to have to be patient for their money, because many times the terms of the financing state that they can't be paid until the lender has been sufficiently repaid. So not only will they have to hold back more financing paper themselves, but they'll have to wait longer to get their money in all likelihood. The security being the shares of the company may or may not be worth much if the new buyers run the company into the ground. And in most cases, the banks have the bulk of the security tied up.
Thank you, Lloyd. So if I'm a vendor, and it sounds like most of the traditional financing is not much different than if it's a third party buyer, but I'm this vendor, and all I'm left with is not all, but I have paper back, the vendor take back, meaning I have a loan from the purchaser. So they will, instead of giving me cash, they give me a promissory note of some description. And I have shares of security. Have you seen, or would you recommend that maybe the vendor still has access to monthly financial statements? Because if I'm waiting till they don't make a payment, it's kind of too late, isn't it?
Absolutely. So as long as there's a vendor note outstanding, the vendor should be asking for financial statements and should be entitled to them, so that they can monitor the financial health of the company before it gets into trouble. And oftentimes we'll see some sort of mezzanine type financing where there might be cash sweeps. So they'll work out a ratio, a debt service ratio with the primary lender, and say anything in excess of that ratio can go towards the vendor note, so that it enables them to get repaid a little quicker. And it's in everyone's best interest to get them taken out as quickly as possible. Sometimes when the managers get their own bank debt paid down to a certain level, then they'll leverage it back up again to take out the vendor note.
Lloyd, is it fair to say this sounds a little bit like what Andrew was talking about in working capital? Let's get some definitions and some clarity up front, so we don't fight over what profit can be distributed or what cash or working capital can be distributed.
Absolutely, Ron. It's extremely important to use proper advisors in this situation, because proper documentation can avoid a lot of arguments, fights, and loss of money. So very, very important to document this well up front.
Okay. I think you wanted to talk a little bit about is that MBO situation, does it fit for you, you being the vendor, and what things you might want to consider at the time?
Yeah, so it's not right in every situation, but it can be a very, very useful tool. We've seen situations where companies tried to go to market and wasn't able to find a suitable buyer, so then looked inward and put together a deal with the management team, and it worked out terrific for everybody. It was smooth transition. It enables management to become owners and have a level of wealth that they wouldn't have otherwise. But it's not always right. As I say, it's important to determine up front if the owners have the faith that the management team can pull it off before even proposing it, because as I mentioned earlier, if it fails, it can be catastrophic, and all the more reason to use advisors. So if I had one takeaway, as Andrea said, the key takeaway, I think, is to use your independent advisors, lawyers, accountants, charter business valuators to set the price, because there will be some animosity around that perhaps, or mistrust as to whether they're being taken advantage of. So an independent price valuation will help to reduce that. And even a M&A professional to help ensure success, because this is a once in a lifetime event, transitioning a company or buying a company. It will get emotional for sure, and it might even get adversarial. So the more you can have somebody in the middle directing traffic and running interference, the better. And the other reason is selling a business takes a lot of time. There are a lot of details. Buying a business takes a lot of time. There's a lot of details. If you've got both the owner and the manager taking their eye off the ball for a period of 3 to 6 months, that can be very damaging to the business. So again, use advisors to ensure that the owner and the manager can keep focused on the business while the transaction is being sorted out.
So Lloyd, thank you. One final question before we move off to the part I think we've all been waiting for. We got all our money. What do we do with it? Does it matter whether it's a management buyout or it's going to be a third-party lender, or sorry, third-party buyer? Does it matter? I guess I'm asking you, does it matter if, the idea is to get management more involved and make you less as a key cog, or to make it commercial goodwill. So does it really matter which process we take when you try to get management ready?
No, whether you're selling to a third party or selling to management, it's extremely important to make yourself less important to the business. If the business can't run without you, it can't really be sold. So in any situation, your primary goal as a business owner is to make yourself redundant.
Okay, so Lloyd, I hear you're saying that we want to work ourselves out of a job, but into a significant paycheck when we sell our shares or our assets, depending on the case.